We are seeing the government talk of the 50-year mortgage. Is it a tool or a smart strategy or a debt trap? So, 50-year mortgage, is it a tool or a trap? Let's talk about it. So, the 50-year mortgage. Here is what some of the naysayers are talking about it. One, you will be paying interest for a much longer period, and so the effective amount of interest that you pay over the life of the loan is going to be much higher. You are going to buy something that you cannot afford or sustain. So whenever you are borrowing, you always typically look at the right sizing of the debt, right sizing of the property, everything. So if you are buying beyond your capacity, then beware. So that's the second thing. And some of the people even confuse you by saying you will not build equity because a good chunk of the initial repayment is going to be interest only. And even afterwards, you're going to be paying the principal back at a much slower pace. Now, that one I find ridiculous. Why? Because I don't believe that by you putting your money from your active living down under the house as principal payment increases your equity. Realize this, that money that you move from your cash pile and push under the home is actually money put to sleep when you need the most, when your life is in the more active phase. So now let's look at the pros of the 50-year mortgage. First of all, the 50-year mortgage is a structure that gives you the ability to mortgage your asset for a much longer period. Of course, they are making you do the payments. And what are the payments? The interest and the principal. We are hearing that the structure will be such that the first 10 years, you're going to do interest only payment. First 10 years is the exact period when you need the liquidity the most. Once the home has appreciated, like in 10 years here in the Bay Area, the home goes double. And that double priced home, after that, you get so much confidence that you don't keep worrying about it. So, you are paying interest only. The big benefit of an interest only loan, if you ask me, is that it keeps the interest going. So here are the pros, and these are more for these two classes. And Bay Area, here in the Silicon Valley, that class is very strong. High income and strong appreciation on properties. These are two big things. And remember, anytime you tweak the mortgage structure in this big of a way, like changing from a 30-year fixed to a 50-year fixed, you are going to see the monthly payments go down. And because the monthly payments go down, your appreciation is going to increase. So if you don't invest before the 50-year mortgage is introduced, think again. You are going to miss out on a quantum leap in appreciation because of that structural change. So, who should and when think of taking a 50-year mortgage? And how do you justify the 50-year mortgage? So, when you're out of the college, you have college debt, and then you're moving up and you buy your home. At that point, your incomes are low, but you're still going to pay your rent, just with appreciation, maintenance and everything to somebody else. So instead of that, if you can buy that home today by reducing your monthly outgo and enjoy more on your life, that gives you your life's fulfillment, and at the same time you will be able to get your real estate position. So in areas like the Bay Area, where incomes are high and appreciation is also aggressive, this is a very smart strategy. It allows you to spread the mortgage payment 50 years. So guess what? If anybody told you that the mortgage is against you and you are paying it, that's correct. But what they are missing out is that that mortgage is being collateralized by the property, not by the person, not because the person is living or dying. If something happens to you, the mortgage is being paid by the collateral, not by you. So at that point in time, that mortgage is going to be deducted from the appreciation that you made out of the property. You are going to pay the rent to your landlord or to yourself. With yourself, it is just going to be appreciation added together. So now, these young graduates will benefit a whole lot by getting their home earlier, start capturing their appreciation earlier, and still enjoy their lives with lower monthly mortgages and make use of the slack that they can for their home. So that's the way this affordability crisis is going to be solved. They will get tax breaks for a much longer period. They will start their appreciation cycles much faster. So in all of these things, I think it's a tool. It's like a knife. You could hurt yourself or you could cut an onion. It's up to you how you make use of it. And that's what I will close at. Think of the 50-year mortgage as a tool. It is as bad as a 30-year mortgage. Just that you have much more control, much smaller payment, and much longer to give it back. You are even capturing the inflation on your side because you are giving the deflated dollar back to the lender. If you think you want to do the full analysis, happy to schedule a call. If you need advice on how to structure it, happy to schedule a call. Thanks for watching. Share it with someone who needs it. See you on my next one.